potential investment opportunity, we are looking at bills and bonds. We shall break down this lesson or episode into a number of chapters. We shall look at what are treasury bills, what are treasury bonds, what are the differences between treasury bills and treasury bonds, what to know before investing in treasury bills and treasury bonds, and finally we shall look at a step-by-step guide in investing in treasury bills and treasury bonds. And without further ado, let us get started. So what are bills and what are bonds? Basically, treasury bills and bonds, these are types of government debt, securities that are issued to the citizens to raise funds for various government projects and expenses. Look at it this way. When you want money for personal development, when personally you want money for a project, you reach out to a friend or a relative or probably a colleague, and you ask them for some money. It can be 1,000, it can be 500,000, it can be 1,000,000. But now the same happens to the government. When the government wants to fund some of its projects and they don't have sufficient funds, they reach out to the citizens and they borrow money from citizens. And this money is used to fund some of the projects that the government undertakes, and in return, it pays them back their money with an interest on top. So basically, that is what treasury bills and treasury bonds are. So we shall start looking at so what are they in which. Let's break them down in a nutshell. What are they? So treasury bills and treasury bonds are financial instruments that are used by the government through the Central Bank of Kenya to raise funds. This can loosely be described as the government borrowing money from the public, as I have explained earlier on. Many a times, just as it happens in our families and in our personal lives, the government many a times also needs funds to assist it to meet its budgetary deficits. For example, the money allocated for infrastructure or money allocated for probably housing might not be enough, and the budget might be less. And so the government will reach out to the citizens through the Central Bank of Kenya to borrow money. And this is where treasury bills and treasury bonds come in. This is where you come in to make an investment to the government. What is the major difference? Many people struggle to know the major difference between treasury bills and treasury bonds. There are only two major differences that will always help you understand the difference between the two. The difference number one, the major one, the main difference between treasury bills and treasury bonds is the tenure. Tenure is the time. Bonds are long time. This might be from 2 years up to 30 years. That is over 1 year, while treasury bills are shorter term. These are less than 1 year, a period of 1 year. So that's the major distinction between bills and bonds. The difference number two that will help you to understand these two is the amount of money. This is referred to as the face value that is required to invest in treasury bills and treasury bonds. So the minimum amount for treasury bills is 100,000 shillings, while the minimum amount for treasury bonds is 50,000 shillings. There is an exception though for the infrastructure bond. Understand that I've said that bonds, the minimum face value required for investment is 50,000, but for the infrastructure bond, the minimum requirement, amount required to invest is 100,000. There's a reason for this. We shall look at it later on. So we quickly start. Let us break down. Let's look at treasury bills. We look at some of its features, some of its characteristics, what sets it apart from treasury bonds. Then later on, we shall look at treasury bonds again, break it down from, look at its features, and then from there on, we shall further on go to what to know before investing in either treasury bills and treasury bonds. Let's get started. Now, when we talk about treasury bills, these are normally, I've said initially, earlier on, that these are short term. So treasury bills are secure short term securities, that securities and investments that matures. Their maturities normally occurs in three stages. There are those that matures in 91 days, relatively 3 months. Then there are those that matures in 182 days or 6 months. Then there are those that matures in 364 days, also 1 year. So when investing, we'll have to mention this at this point. When investing, you go to the CBK portal, and when you look at treasury bills, you'll see treasury bills listed under those categories: those that matures in 91 days, those that matures in 182 days, and those that matures in 364 days. Feature number 2 for treasury bills is they have attractive interest rates, and each of those categories that I've mentioned have got different in interest rates. For example, as at today, the time of recording this video, the 91 days treasury bills, the interest rate is 15.99% per annum. 182 days, the interest rate is 16.82%, and the 364 days, the interest rate is 16.87%. I have to mention that this interest is per annum. So when you are calculating the expected returns, you take that percentage divided by 100 times the amount invested. That will be the amount per annum. Then you can divide that by the number of months in a year, that is 12. And then when it is for 3 months, now you multiply that one by 3. For 6 months or 182 days, multiply by 6. And if it's 1 year, the amount that you get after the calculation will just be the amount that you will get. Take note that this interest is per month and not quarterly or half annually, like that. I hope that is clear. Feature number 3, or characteristic number 3 of treasury bills, is that they are auctioned every week on the CBK portal. Feature number 4, we quickly move forward. Now, there are two types of treasury bids. When you are bidding, we have got what we refer to as the non-competitive bids, and we have got what we refer to as competitive bids. What are they? For non-competitive bids, you require a minimum face value of 100,000. I've mentioned that the bare minimum amount you're required when investing in treasury bills is the 100,000, and the maximum that an investor can invest is 50 million shillings. This is for non-competitive bids. I will explain the difference. For competitive bids, you require a minimum face value of 2 million Kenyan shillings, and there is no maximum amount. You are not capped. It doesn't cap the maximum that you can invest for competitive bids. Now, I want to explain just a little bit. For individuals, you are always advised to when you are selecting, you select non-competitive bids. Now, non-competitive bids have got kind of fixed interest. For example, when it's 91 days or 182 days or 364 days, that interest is fixed. You can't change, or you can't request for CBK to give you another interest. But when it comes to competitive bids that require minimum face value of 2 million, you can negotiate. Like, for example, if you are investing 100 million or 200 million, there's a place where you put in the amount of interest that CBK should pay you. Like, you have some bargaining power when it comes to competitive bids, and you find that this is where like big institutions are investing. For example, this is where other banks are investing. This is where other microfinance companies are investing. And so, because they have a lot of money, they have a bargaining power. And you might realize that when a person in non-competitive bidding, is being paid at 16%, a person in a competitive bidding can even be paid at 20%. This is because their negotiating power is so high. They're putting in a lot of money. The government, for example, wants to raise maybe, for example, 20 billion, and a company comes in and they're willing to give something maybe 5 billion or so. So you realize that their bargaining power is huge, and so they can actually dictate. That's the word that I'm trying to look for. They can actually dictate their interest rate at which they wish to be paid. But you, as an individual, when you are bidding, please make sure that you bid for non-competitive bids. If you bid for competitive bids, then your bid will not go through. That's a secret that I have told you. Finally, the last feature of treasury bills is that treasury bills attract a 15% withholding tax that is imposed on interest. For example, if you calculate without the interest, without the tax, and you realize that probably you are supposed to be paid 100,000 at the end of the year, depending on how much money you invested, you will, at the end of the day, 15% tax of that will be something like 15,000, and so your take home will be 85,000. So it's paramount that you understand that treasury bills attract a 15% withholding tax, so it's taxed. Let us also look at treasury bonds. Feature number one that is that treasury bonds, these are secure medium to long-term investments, and for example from 2 years and above all the way up to on CBK platform they say up to around 30 years. The feature number two, treasury bonds require a minimum face value of 50,000, and apart from infrastructure bonds which require minimum investment of 100,000. Why is it so? Now, infrastructure bonds have not been attracting tax, and that's why they are very lucrative, and that's also another reason why their minimum face value is at 100, despite other bonds the minimum face value being 50,000. This is because they do not attract any tax. So the amount of interest, if you are investing, for example, 100, if you are the interest that you're supposed to earn is 100,000, then your take home will be that 100,000, and you will not be deducted the 15%, 15,000. And so this is why they are normally very competitive. Whenever the bids are out, people are always scrambling to bid for the treasury, for the infrastructure bond, because of them being very lucrative. Feature number three of treasury bonds is that they are normally auctioned monthly. Remember, we say that bills are auctioned on weekly basis, but bonds are auctioned on monthly basis. Feature number four is that despite them being long-term, they pay interest biannually after every 6 months throughout the maturity period. For example, if you have invested in a bond that matures after maybe let's say 10 years, after every 6 months you will be paid an interest across the 10 years that you have invested. Feature number five, which is a very good feature about treasury bonds, is that their interest rate is fixed, and normally this fixed interest rate is determined at the time of auction. For example, when they are being auctioned and you purchase a bond at an interest of 15%, for example, that interest will be locked for the entire period. For instance, if it's 15%, then you are guaranteed that at the end of the 10 years that you are investing with on this particular bond, you will get an interest that can be actually the value. You actually know the value, because this 15% interest rate will not change across the 10 years. This makes bonds predictable and a reliable long-term source of income and investment opportunity. Feature number six, characteristic number six about treasury bonds is that Now, two kinds of people can invest in T-bonds. Number one, we can have individuals investing, or we can also have corp corporates investing. I've mentioned that banks can invest in treasury bonds, insurance companies can invest in treasury bonds, SACCOs can invest in treasury bonds. So it's open to both individuals or corporates. And the only thing that you actually need to do is you open a DAO's CSD account and then go ahead with bidding. Then the last feature about treasury bonds is that they also attract a 15% withholding tax for bonds maturing under 9 years. But this reduces, this interesting, this reduces to 10% withholding tax for those bonds with over 10 years. What does it mean? That if you invest for 10 years or more, you are actually going to be the interest that you're going to pay will be slightly lower by 5% as compared to someone who invests under a period of 10 years. So this actually just encourages long-term investment for prospective investors. That is it. Those are the features under treasury bills and treasury bonds. Let's quickly look at what do you need to know. If you are new to investing in bills and bonds, you have to understand this, that the thing that you have to understand, let's call them bare minimum. Understand these bare minimums before you opt to invest in treasury bills and treasury bonds. Number one, understand the minimum investment requirement. We are also calling the face value. Treasury bonds 50,000, treasury bills is 100,000. Point number two, what you also need to understand is that you need a CDS account. A CDS account is a central depository system account. Now, in a normal bank account, your money is stored in that savings account or that checking account. But when you buy bills and bonds, they are stored in a CDS account, and you open this CDS account through the Central Bank of Kenya, or you can also open it through a licensed stockbroker or an investment bank. So this account will allow you to hold the government securities that you have purchased until their maturity time. Thing number three, another important thing that you have to understand when investing in bills and bonds is they are tracked of is their interest rate. Sorry, so bonds have a fixed predetermined interest rate, and this matures interest rates and maturity dates. When you buy a particular bond, the interest rate is fixed. I've mentioned that 15% for 10 years. So the interest rate is determined, the maturity date is also determined, and this one cannot be changed. So this makes them relatively safe option for investment. On the other hand, it's worth noting that treasury bills are sold at a discount. What does this mean? This allows investors to select the value, the face value they will receive when the bill matures and acquire it at a price that is slightly lower than the chosen amount. It's also important to note that when you're investing in bills and bonds, it's important to monitor your investment. Always keep a track of your investment periodically. This can be monthly or this can be quarterly. And this helps you to stay informed about any updates or announcement from the Kenyan government or the relevant authorities that are been entrusted with the investment. It's also important to know the maturity dates. Treasury bonds are long term. They mature within 1 year to above 1 year. That's why I mentioned 2 years to 30 years, depending on the type of bond. And we also mentioned that bills, on the other hand, can either mature in 91 days, in 182 days, or in 364 days. That is 1 year. It's also important to understand the payments when the payments are being made. While bonds are usually issued by the Central Bank of Kenya, CBK, every month. The interest payments are by annually. I've mentioned this, that should be paid after every 6 months, biannually, throughout the bond's maturity time. As for the treasury bills, they mature in less than a year. Hence, the returns are paid out within 3 months, 6 months, or 12 months. That translates to 91 days, 182 days, or 364 days. So your interest will be paid depending on what which one did you invest, either 3 months, 6 months, or 12 months. Let's look at how to invest in bills and bonds. Now that we've known what to know before investing, let's look at how do you start. So in our country, Kenya, right now, individuals and corporate entities have the option to invest in treasury bills and treasury bonds, either as a nominee of a commercial bank or an investment bank in Kenya. However, if you maintain a bank account with a local commercial bank, you can invest directly through the central bank to avoid additional fees. Understand that if you choose a broker, I didn't mention this earlier, but if you choose a broker, then you will have to pay some brokerage fee because they will be investing for you. For example, if you choose another bank that is not the CBK, for example, Bank X, and so that Bank X invests for you in the treasury bills or bonds, Bank X will charge you an interest, maybe 2% or 3% of the amount of interest that you will have earned. So if you earn an interest of 10,000, for example, from CBK, from bills or bonds, then this bank, which is your broker, they have done work for you. So they will take maybe 1,000 or 2,000, depending with the percentage, the rate that you signed the agreement upon when you in their terms and conditions. So, but my advice is, in bills and bonds, the process is quite straightforward. So you actually don't need a broker per se to when you're investing in this. You just go to the CBK, decide on how much you want to invest. If you are investing in bills, select whether you want 91 days, 182, or 364, and then you place your bid, and then you finish the process. I place down those steps towards the end. So this is a step-by-step guide on how to invest. Step number one of investing in either bills or bonds is that you open a CDS account. We mentioned that this is where your bills will be held, for example. So begin by opening a CDS account with the Central Bank of Kenya. This helps to track ownership of the government securities. And what do you need to open this CDS account? You need a Kenyan commercial bank account. Yes, you need a Kenyan commercial bank account or its branches. You can either go to the HQ, or you can go to the branches and fill out a form, a form that with your accurate details, and then you submit your documents for identification document. This can be an ID, this can be a passport, or this can be a foreign military passport or a foreign passport. After you've done that, step number one. Step number two, you select the investment of your choice. We've mentioned the durations of treasury bills, and you've also mentioned treasury bonds. So choose, based on the amount that you want to invest, choose the investment of your choice. After that, go ahead with complete the registration process. Now I will not go into step by step because this video is not meant for that, but I'm just taking you through the procedures, so that should you want to do it, you know the general steps that you need to take. So after selecting the investment of your choice, you do a registration. Once you're ready to to complete the Treasury bond application form, provide the information about the bond of your choice, such as the issue number, the duration, and the face value. The portal, there's a space for each of these ones. The issue number, the portal provides a space for that. Then the duration and the face value. So next step under the registration, so you include your personal details. You also include the CDS account number. You also include the commercial bank account number and the source of investment funds. Understand that when you talk about the source, you can use either your salary for investment, or you can also use bills or bonds that are about to mature. For example, when you're placing in a bid in maybe December, for example, no, let me use July. This is July. So if when you're placing a bid in this month of July, and you have another bid that is maturing, either bills or bond that's maturing in August, the platform allows you, CBK allows you to place a bid using the bills or bonds that are about to mature. So you don't need to have cash in hand, or you need to have some other money in hand before investing. You can actually use money that's already in the system and it's about to mature in less than a month or so. So this option is available, and it just enables you to continue investing. Now, after investing, there are normally auction results. This is normally done, let me check that. It's normally done, I think, the following Thursday or Monday. Let me just check that. So the Central Bank Auction Management Committee, normally known as AMC, reviews all the bids from all people who have made their bids and determines the cutoff rate and weighted average for the market determined coupon rate during the 4 p.m. auction launch. Auction results are then published through the Treasury Mobile Direct, known as TMD, and Twitter, and also the CBK website statistics section. So from here, successful applicants are able to know whether their bids were successful. So the applicants must contact the CBK, of course, after you've known that your bid has gone through, to confirm their acceptance and the payment details, which must be made by 2 p.m. on the following Monday or Tuesday, if Monday is a public holiday. Payment now. If you've already confirmed that your bid went through, you've gotten the communication either from the portal, now you're supposed to make a payment. So you submit the specified amount by the deadline through either the banker's check, or you can just deposit the money directly to the account. I have to mention that when you're making this payment, there is a specific amount that you'll be told to pay. For example, if you have been told to pay 100,000.75 cents, do not round off the 75 cents and say that now you are going to pay 100,001. Your bid will not go through. So do not overpay and do not underpay, but pay the exactly amount that the bid requires you to pay. This increases your chance of your bid going through. Remember, you can still win the bid, but when you make a wrong payment, the one I've mentioned, you will still be disqualified. Then, of course, after you've made the payment, there will be maturity proceeds depending with what you have invested in. So after investing in treasuries, interest payments are sent to the investor's commercial bank account as indicated in their CDS account throughout the investment tenure, in either bills or bonds. Note that upon the maturity, bonds maturity period, the investor receives the final interest amount and the face value of the bond. If it was 100,000, you invested 100,000, and probably per annum you are earning 15,000, for example. So at the end of every biannually. If you are earning 15,000 per annum, then because bonds pay biannually, then you'll be paid after every 6 months. You are paid 7,500. But at the end of the tenure period, your investment period, you get the face value of the amount that you invested. And remember that you have been earning interest all along the 10 years. That marks the end of investing in bills and bonds. Just something to note as we conclude. Always remember that investing in any financial instrument carries some level of risks. I always tell people this: as much as we say that bills and bonds are secure because we are investing with the government, is paramount to note that when you are investing, you are risking your money. So it's essential to understand the risks, understand the rewards associated with the treasury bills and bonds before making any investment decisions. It's always advisable to seek advice from qualified financial uh, advisors so that you tailor your investment strategy according to your financial goals and risk tolerance. Thank you for watching. If you haven't subscribed, I call you to subscribe so that you don't